So we know that the stock market has been moving in the wrong direction, and stocks have not been acting how stocks are supposed to act. And even though we're all beaten down and all of our portfolios are red and losing money, it could be just the beginning of something starting to get much, much worse, which I'm sure is the last thing anyone wants to hear. And hopefully, it can be all wrong and not really add up to anything. But that's just not what everything is screaming at the moment. See right here the heat map of the stock market here, the S&P. It's all red. I mean, a little bit of green, but for the majority, it's all red, and people are just hemorrhaging money. Nothing feels good. This is just for today. We could look at one for the month, and you can see it's even worse. I mean, you have stocks like Apple going down almost 10% in 1 month. Absolutely crazy moves, and it still could get worse from here because there's a lot of things going on in things like the oil market and in bonds that seems like it's on the verge of imploding. You can see here with oil, this chart is oil is at 90.90 for a barrel of oil. You can see it recently, it's been moving down. We've had constant, consistent moves down for many months now. And now recently we have this spike up here at the end, and that could be a combination of the strategic oil reserves absolutely plunging, which has been used to try and push the price of oil down recently, and OPEC now saying that they are going to cut production by 2 million barrels per day to shore up prices. So this is basically being done just so that they can try and make prices more expensive because of the countries in the Middle East, countries like Saudi Arabia, they can produce oil for dirt cheap. I think their cost for production per barrel is like $10 a barrel. It's something ridiculous. Where like in Texas or to make crude oil like WTI, that's costing more like $60-$70 a barrel. At these $90 per barrel, the profit is 9x for these countries. They're just rolling in money from doing this. And the only thing that is tricky is we can see this isn't over $100, and a lot of people expect it to be around 90 to 100 for the foreseeable future, for at least the short term, from this cut in production. Because even though they're cutting production and they're bringing things down, the demand is going down as well. People do not have money. People are not going on vacation and traveling all over the place. The majority of people are going to work, coming home, and maybe going to the grocery store once a week. So a lot of not traveling going on, which means demand goes down, and you can't just force demand. So if you cut production but demand goes down still, price could still drop, but we're probably going to be around 90 for a while. And an analyst here talks about this, them cutting production, saying further squeezing already tight supplies will be a slap in the face for consumers. The selfishly motivated move is aimed purely at benefiting producers. In short, OPEC is prioritizing price above stability at a time of great uncertainty in the oil market. So obviously OPEC wants the price to stay up here because they're making ridiculous amounts of money, and it's almost like we should probably create our own oil and somehow get some oil for ourselves here in the west side of the world, because it's just a lot more controllable instead of relying on a country that can make oil for $10 a barrel and then tell you, no, we're not producing more. We're actually going to force the price up because we want to make more money. And also he said that a return to $100 is possible. A more likely scenario in the short term is that oil prices hover in the $90 to $100 range as the market digests economic data releases. So not only is the stock market and assets collapsing, now they're staring at this and seeing what's going on with oil and saying, man, this is going to put more pressure on consumers. It's going to force gas prices and energy prices higher, and it's going to take money out of them being able to spend it on other things. So right now, the market is kind of looking at the Fed and rates and deciding, what are they going to do? Are they going to pause these rate hikes? Are they going to hike them even more? Are they going to start cutting rates? Maybe the cuts are coming sooner than most people might expect. But that's one pillar. The market's staring at the Fed. The second pillar, the market's staring at things like oil, what's going on in the world with oil markets and the bond markets, because a lot of these companies or like pensions are invested in bonds And if they go under, a lot of people are going to get affected. And we actually have some pretty big Fed data with the CPI coming out in later this week. So we'll see what those numbers are, how they reflect, and if inflation is actually going down still, or if it starts to go up again. And if it does that, then we're falling and collapsing. But as for the bond market, we can see the collapse of the global bonds is not priced in. Absolutely, it's not, because bonds are supposed to be the safest investment you can make, because they're usually from a country. If you're getting it from a government, typically that government can print its own money. If you're getting bonds in a currency that the government can't print that money on, then there is risk there. But if you're getting it from one that can print the money, then there's really no risk, other than not waiting for the maturity date and wanting to sell your bonds, but the price collapsing for that bond. So the bond system is super complex, and it's way too much for me to completely understand. But I do know we have seen countries recently starting to flip and go into the quantitative easing again, start buying because their bonds are collapsing. So you can see this on September 22nd, Bank of Japan spent about almost $20 billion to stem the yen slide. Its first intervention to support the currency is 1988. So this is Japan intervening, trying to stop the yen from collapsing and going to zero, or strengthening and then forcing bonds down and forcing bonds going to zero. And if bonds do that, you have a whole big implosion that happens from bonds, which the boring way to invest can have a massive impact on everything. So the Bank of Japan intervening, which is sending the yen to, levels not seen since 1990 for its comparison to the dollar strengthening, and the yen is absolutely collapsing. Pretty much every currency in the world is collapsing except for the dollar. So that's interesting. It's just causing a lot of volatility and a lot of uncertainty in these bond markets that across the globe. And we also saw the Bank of England come out and start quantitative easing again. And now they have doubled their temporary, because everybody knows if they stop buying, the price is just going to collapse and their pension funds are going to go bankrupt. This already almost happened. It was like a day away from happening in England. Their pension funds were at risk of going bankrupt because bond prices fell so hard. They were going to get margin called. It was just going to be a bad scenario for everybody. The Bank of England stepped in, turned on the money printer, and started to buy up those bonds. And now they have it set to 10 billion pounds per day that the government is buying to support the market, because if they aren't buying it, then that means the price goes down, and they're in the same scenario where their pension funds go under. So really tons and tons of bad news for the market, and obvious why it's falling so much and continues to fall, and how it could just get even worse. But the only good thing that's going on is, because it's getting so bad, especially in the bond market, that it might force the Fed to stop raising rates and maybe even start cutting rates before anyone expected them to do so, to support the bond market. Because if we get in the same situation as England, where the bonds fall so hard that the pension funds start to get in trouble, then you see the government's going to have to step in, because they don't want the pension funds to go under. So it's a pretty big saga playing out. A lot of intricate parts with the bond market, which is super complex, even though it's supposed to be a massively kind of easy investment. It's supposed to be the safest investment you can make, and right now it's causing the most amount of pain. So we'll see how the rest of the week plays out. There's a lot of things happening for the week. We got CPI data, we've got lots of readings coming out, and the market will have a lot of things to react to, I'm sure. If CPI comes out, if inflation starts to tick back up, it's going to be an absolute freak out and meltdown. If it continues to go down slightly, then it's probably still going to move down. But if we have a massive move down in inflation, like it beats expectations to the downside by a lot, then maybe we could see some green for the market for the first time in a while. But that's going to do it for this video, guys. As always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. And I'll see you guys in my next video.